Good morning and welcome to the Killik & Co market update. This week there's been quite a lot of focus on the Chinese market because the country's Party Congress is going ahead. This is a conference that takes place every 5 years and it should give an indication as to the economic strategy for China over the coming 5 years. I think China is becoming increasingly relevant for investors. It's now home to over 18% of the world's population, and the country does have the world's largest banking system when measured by assets, so it really is becoming impossible to ignore. And also it really is only relatively recently that the Chinese stock market was opened up to overseas investors. It was only in 2003 that foreign institutions were allowed to buy Chinese shares, and only in 2014 that foreign individuals were allowed to invest in Chinese companies. Back to the Party Congress, I think there will be 3 main areas of focus. The first one is the excessive level of debt in the Chinese economy. A lot of Chinese corporates and also the Chinese government are sitting on huge amounts of debt, and that is a concern for some investors. This week during the Party Congress, the central bank governor did come out and say that he too was worried about the level of debt in China. So any action to bring that down, I think, would be a good thing for the Chinese markets. Second area of focus could be the potential reform of state-owned enterprises. A lot of large companies in China are owned by the state, and many of them are seen as being quite unproductive. So any reform that could make those companies a bit more productive, again, I think would be a good thing for the Chinese economy. Last of all, it is expected there will be some action on climate change. I think China was quite against the US pulling the country out of the Paris Climate Accord, so I think that will be a focus of discussion as well. Looking at some recent data for China, we did have the latest GDP growth numbers out this week, and they showed that the economy is growing at 6.8% per year. I think the market was pleasantly surprised by that. The Chinese target for growth is 6.5% per year, so to come in at 6.8% I think is definitely a positive. And just to put that into context, I've got some numbers here for GDP growth rates for other major economies. So here in the UK we're growing at 1.8% per year, and in the US it's 2.6% per year. So 6.8% for China I think is a very high number indeed. Some more interesting data for China is the current rates of wage growth. This is currently a concern for a number of developed economies around the world, and we're constantly hearing central bankers in the UK and the US talking about their concerns about levels of wage growth that are too low. But in China, the level of wage growth is actually relatively high. Have a look at this chart here. Wage growth in China is about 10.1% per year. Here in the UK, it's just 2.1%, and for the US, it's 2.6%. So very interesting. I think this shows that the Chinese economy is doing well, but also it does show why some elements of manufacturing are moving back to other countries. So 10 to 20 years ago, wages in China were incredibly low, and a number of other countries did move manufacturing to China to take advantage of those cheaper wages. Now that Chinese wages have increased so much, we are seeing what we'd call reshoring, so manufacturing moving back out of China to the countries where it first came from. So I think that is quite an interesting statistic. And also this week we've had the 30-year anniversary of Black Monday, which was a day in which global stock markets fell quite heavily. In particular, the Dow Jones Industrial Average had its greatest ever one-day fall, and it came down 22.61% in a single day. And even to this day, it's quite poorly understood as to why stock markets came down to the extent that they did. I think one of the major reasons is that program trading or algorithmic trading was still in its early days. So as stock markets started to fall a bit, I think a lot of algorithms kicked in and automatically sold stocks, and that gained momentum and pushed stock markets down even further. So that's one potential explanation, but as I said, to this day it is still quite poorly understood. Just moving back to the Dow Jones Industrial Average, it's quite interesting to note that in the same week we've had the 30th anniversary of Black Monday, but also the Dow has reached a new record high. So on Thursday this week, the Dow reached a new record high, as shown by this chart. So the Dow reached a level of 23,157. And here in the UK, we've also had some quite negative data on retail sales. So these fell by 0.8% in September in comparison to the month before. And if I go back to the chart that I showed earlier about wage growth, I think that does offer quite a good explanation as to why this might have happened. So back to the wage growth chart. That shows that annual wages in the UK are growing by 2.1% per year. However, this week, inflation in the UK came in at 3%. So that means that wages are growing at 2.1%, inflation is growing at 3%, therefore wages in real terms are falling. So that does suggest a reason why retail sales are perhaps falling, because people do have less disposable income. So current rates of inflation and low wage growth in the UK are an ongoing concern for the Bank of England. And moving on to the week ahead, it is still the third quarter reporting season, so lots and lots of companies will be publishing results. In particular, it's quite a big week for technology stocks, and we will be looking forward to results from Amazon, Microsoft and Western Digital. That's it from us. Have a great weekend, and we'll see you next Friday.